today. So I'm going to just start out with a little conversation with Brian here. Now, China tightened credit, but the big news is Goldman Sachs fraud charges being levied against them. This has got some very potentially serious implications for the non-regulated industry, as we could see some liquidation of positions in the OTC market, and that, of course, a lot of traders back that up with futures contracts, so that could put some pressure there. But penetrating the Goldman veil and getting deeper into what went on behind the financial failures of these CDOs could become a big thing. And they're already mentioning Madagar in the news, is that they'll be next, and that's who the crosshairs are really going after. And this could affect many hedge funds as they move to the sidelines and reduce risk. And I'm just questioning, is this what's driving the crude oil market, and is there a way that we want to take advantage of that?
Yeah, Bill, this definitely is one of the key things in the market today. A lot of this pressure is coming from money leaving the market due to risk aversion, and to compound that, we're also seeing selling of energies due to the reduced fuel usage in Europe because of the flight stoppage. So this is two bearish things happening all at once. You almost have to look at it and say, well, geez, if that's the case, it's holding in there pretty good. You're going to have May crude oil go off the board tomorrow. Tomorrow's last trade. That means June's going to be front month contract on Wednesday, and we still have June crude oil trading over $83 a barrel after all of this has happened. So your weak leg when all this is going on is going to be heating oil. That's going to be your proxy to jet fuel. So heating oil is going to be the weak leg. When all this issue is solved between as far as the flight stoppages and that stuff resumes, you're probably going to see heating oil regain some of its value against RBOB and crude oil. But in the meantime, that's going to continue to be the weak leg. But as you can see, we did have 2 days of aggressive selling. Today's low was supported by what was the old downtrend from the January highs. And if this market can catch itself here and push itself back over 84 short term by the end of the week, then it's really not going to look that bad at all. And again, 84 is a key area, being the breakout point on the continuous chart to the upside. So our 20-day moving average looks like that's going to be a number. If we can get a move back above that and a solid close above that, then that should resume the uptrend that we're in right now. But at this point, you have to be looking at selling rallies after this type of a move. Me personally, I don't really see any reason, if you don't need to be involved in this market, to even get in it. There's too much uncertainty right now. At this point, the risk of this market going either way is pretty big. But if you wanted to pick a side and go with it, I'd be looking to sell. Now, looking at the dollar index, last week we had gapped lower after Greece got a bailout package, and the gap was the 40-day and 50-day moving averages. Now, Friday we had closed that gap, and today we're trading above it, but this market is not closed yet. If this dollar straight and we find ourselves back below the uptrend at the end of the session, that's going to look like a failure by this dollar after closing the gap. But we do feel a close above this 81.10 to 81.15 area would be a resumption of the uptrend. It's probably worth making it close at that area 2 days in a row before going with it. But the risk aversion in the market could cause this dollar to keep going up short term.
Did you have a trade then in the dollar?
At this point, a close over 81.15 is going to look like a buy. So we could be a buyer at that price on a close, risking below last week's lows.
Which was about 80.20?
Yes, correct. Otherwise, this market is in a short-term downtrend. If we do find a little bit of support later in the week, back up to that 81.70 area, you could be a seller there risking the new contract highs.